Hello, hello, hello. What's going on, YouTube world? How are you guys doing this evening, night, morning, depending where you are in the world? Hopefully you guys can hear me loud and clear. Everything looks good here on my end. And the last couple of my market update webinars have been turning into some educational webinars with some very in-depth breakdowns of fundamentals, market sentiment, higher time frame, and so forth. But this one's just going to be a clean-cut trade ideas webinar, just getting straight to the point, okay? But hopefully, actually no, most people won't watch those webinars, but if you really want to learn, if you're really trying to increase your understanding of the financial markets, the last couple of market update webinars, higher time frame one, scalper setup series, I've given you guys A1 information to follow. And we're going to be continuing from that A1 information for today's market update and trade ideas webinar. So, for those of you who are new here, welcome to the Capital Hungry Market Update and Trade Ideas webinar, where we will be doing analysis and giving trade ideas on gold, GJ, GBPUSD, EURUSD, USDCAD, and US 30 stock market index while looking at what fundamentals are in play, market sentiment, and economic events on the docket before we jump into the trade ideas on individual pairs. Now, what we're looking to continue to play is our main macro information advantage and what has been holding the most weight in the markets, which has been the central bank monetary policy sentiment. What I'm specifically talking about is the Federal Reserve's aggressive rate hike cycle. This is the reason why dollar index has been so bullish over the last 8 months, why gold has been so bearish, and why other asset classes such as the US stock market and housing has been so bearish. What we were playing in the short term as buyers peaked new highs in 20-year and levels that we haven't seen in 20 years with the dollar index edging to 109 was short-term pullback structure. This pullback structure was active for almost a month, as in the short term we had sellers in control with buyers liquidating positions from better price points, sell side liquidity being collected to of course provide that exit relief and create this pullback that you see in front of you, right? So we were playing that pullback accordingly, but understanding once we come to key demand zones that we can start seeing buyers in the market. As we were marking out key price points of interest, our first very key interest level was around 105 flat, which is previous intraday highs pretty much in line here. You can see when you're looking at the sequence of events, we anticipated and called the double bottom at 105. We've had increased probability of more aggressive rate hikes coming for the next FOMC meeting, and any poor data in the short term is getting faded out. If we can see dollar trading back above 107, even give or take a minor pullback, there's a lot of potential for dollar buyers to be back into the scene on the higher time frame, heading back into the 109 highs. This correlation of the market pricing in more aggressive rate hikes to come, which may come with a lot of the Fed speakers midweek and later in this week, is also going to keep potentially stock markets rejecting 34K when we're looking at US 30, and also keep gold more bearish below the 1800s, which I called some amazing sells for you guys the last two market update webinars to really pay attention to gold at the 1800s and higher time frame retest of bearish structure and sell side liquidity zone. So when we're zooming out here on dollar index, it does look like we're starting to jump back into our higher time frame bullish bias. Overall, we have buyers consecutively printing higher highs. We only have very short-lived corrective phases, whether it's a consolidation zone or whether it is a pullback phase to allow exit relief in the market and set up prices from better demanded zones of interest. For example, this pullback, more of a consolidation and collection of order flow and buy side accumulation here. Pullback phase, pullback phase, pullback phase. None of these pullback phases have broken macro bullish market structure or canceled out any of the aggressive upside movement. And if you can also identify that you start to get that support formed and buyers jumping back into the market, breaking above that corrective pullback structure that you can identify with your intraday trend lines and just looking at your higher highs and higher lows, in this case being the pullback structure with your lower highs and lower lows, you can see we're seeing a similar sequence of events where as long as we're holding above that support level and as long as we're trading above that corrective structure, we have a lot of potential to continue the higher time frame trend, as there's still going to be more signals of rate hikes to come. The Feds have not slowed down anytime soon, and the short-term optimism we've been seeing in the stock market is really delusional and just a bull market trap to really trap a lot of buy-side liquidity and to push price up to more favorable sell-side liquidity zones where the whales will cash out, leaving the retailers and any fool holding the buys with the bag, right? So our macro sentiment, as long as dollar is holding above 105 and also trading above this bearish corrective structure, give or take a minor pullback, this correlation move here, highlighted in yellow, what this shows us is the market further pricing in Fed rate hikes. Right? Now, the correlation isn't between gold and the dollar directly, it's between this fundamental catalyst and the impact it has on gold and the dollar. If we see dollar following this pathway of price, continuing its higher time frame structure, going back to its previous highs, what that shows me fundamentally is the institutional order flow is adjusting from an algorithmic perspective, is adjusting to more rate hikes to come by the Feds and pricing in those rate hikes to come well ahead of the September FOMC is exactly what we've seen happen before a month or weeks before every FOMC over the last 8 months. Oh, sorry, the webcam. Right? So if we see the market, if we see dollar holding well above 106, and also trading above 107, what that shows me fundamentally is the market investors, smart money, the whales, whatever you like to call it, they are pricing in further rate hikes to come. This will also lead to GBPUSD downside, EURUSD downside, and gold downside respecting macro structure. So let's look at something sorry about that flashbang. Let's look at something very interesting here across the board. You can see as the Fed has been in their aggressive rate hike cycle for this extended period of time, dollar has been bullish. Because rate hikes are bearish for majority of asset classes and make institutional lending less favorable, decrease investing activity from an institutional perspective as well, and you also have these asset classes at all-time high prices, that's the same reason why even though US 30 is having a very aggressive cat bounce and bear market rally, overall US 30 over the last 6 months has been bearish because of the market pricing in those rate hikes and more rate hikes to come. Gold overall over the last 6 months has been bearish as well. So our higher time frame structure is still active across the board. You might be saying, hey Jeev, US 30 is looking pretty bullish now with the aggressive upside move it's doing here. But don't get fooled out just like that. Look here. This is the bear market that occurred during the 2008 GFC financial crisis. This is US 30. You can see overall you had a double top at all-time highs at that point. Then you start having sellers driving down consistently lower and lower as market fear starts to increase. As you have these consistent lows printed, you also have these bear market rallies occur. You can see multiple bear market rallies that occurred as these minor lows were being printed. The largest bear market rally was near the secondary bottom here, where it looked like at that time you're starting to have the stock market bottom in and buyers back into the scene. And this bear market rally also lasted almost 110 days, right? So look at this situation of the 2008 global financial crisis and look at the current structure that we're seeing on US30. I'm going to keep the drawings on the screen exactly the same, right? I'm going to keep the drawings on the screen exactly the same, but now let's go look at current structure. Isn't that very, very interesting to everybody? Right? The current structure we're seeing in this bear market on the stocks is no different than what we saw on the 2008 GFC, is no different than what we saw on the year 2000 on the NASDAQ or S&P 500. This is a fake out so far. Unless we actually return back to the all-time highs, we can have a little bit of continued upside move on equity still, but more than likely, as we get more signals of rate hikes to come, start to turn back bearish as we have increased probability of long-term recession, high risk inflation still evident, more aggressive rate hikes to come, and less probability of stock market buyers continuing to invest in the market. So again, look at this. Look at the sequence of events. This was the 2008 GFC. Huge bullish rally that extended for a period of time to all-time highs. At those all-time highs, you have a double top, which was the last peak of the stock market before the GFC, right? Then you start to follow this pathway of price. Downside move, short-lived pullback, downside move, short-lived pullback, downside move, extended bear market rally leading to lower lows and a meltdown there, right? The current situation when we're comparing to the 2008 GFC, just based on market structure and understanding, is that we are in this phase here, having an extended bear market rally, fake optimism in play there. Do you understand what I'm saying? A trap to trap a lot of buy-side liquidity, tell the public there's no recession, tell the public the stock market is safe, have a short-lived rally that looks bigger than the previous ones, and this is very, very common and seen across the board, right? When you're looking at current structure to this day, you can see the exact same thing taking place. Massive rally overall, double top that occurred here that just signaled less buy-side liquidity and the market topping off. Unless US 30 is actively trading well back above 34,500 or 35K, I see this as the last dead cat bounce and bear market rally and squeeze to really just be generating more sell-side liquidity before turning back bearish again on the higher time frame, similar to the 2008 GFC and similar to what we've seen on the NASDAQ and S&P 500 during the year 2000, 2008, and what we're seeing now, right? So higher time frame bias of stock market bears is still very much valid. Higher time frame bias of gold bears, like I was telling you guys, don't get freaked out yet just because you're having this extended upside play. Higher time frame bias of gold bears with potential more rate hikes is still very much valid. And higher time frame structure on dollar being bullish, which is going to correlate to GU bears and EURUSD bears, is still very much valid. Who here in the chat has been following along the previous market updates I've been giving you guys on YouTube? How many times did I tell you guys that in the short term we've been playing some pullback structure and corrective structure, but don't ignore the higher time frame bias and macro fundamentals? How many times did I tell you guys, patiently wait, dollar buyers will be back into the scene? Watch the gold rejections and sells at 1800. Watch the EURUSD rejections at previous lows and sell side liquidity zone. Watch the sells on GU at previous lows and sell side liquidity zone as well. Give me a 1 in the chat if you've been following it along, if you've been enjoying this content, if you enjoy the analysis, and it's helping you learn a lot and take some effective trades. Okay? I appreciate it. But now, that higher time frame bias I've been breaking down to everybody and we've been talking about, that's what we're looking to extend today, right? As long as we're looking at gold in this sequence of events, it's still very much active of what we want to see. Okay, let's look at the sequence of events. Very strong sell side liquidity zones and macro bearish market structure. Right? You want to see even in more detail? Let's look at this. So, sellers print consecutive lower lows. Overall bearish market structure on the higher time frames. Sellers have a very aggressive run to the downside, and as you have billions of dollars being made in the market there, you have sellers liquidate positions at very key price points of interest, this being that 1680s demand zone. And then you start to enter what is called pullback or corrective structure. You can see this pullback structure from these lows extended hundreds of pips, going from 1800 all the way to 1870s, and you retested these highs multiple times before finally shifting structure and turning back bearish again. When you're looking at this sequence of events, it's not that much different, is it? Yes, we had a very aggressive bounce from 1680s. We expected that. We called that in the higher time frame webinars. Hitting that institutional demand zone, sellers taking profit and liquidating positions, hitting a major buy side liquidity zone on the higher time frame, and we entered this pullback phase. But these pullback phases on gold are completely normal. You can see it time and time again, right? Sellers print consecutive low. Seller print a higher time frame low. Seller print a higher time frame low. Pullback phase that occurs. Pullback phase that occurs. Pullback phase that occurs. Doesn't break overall macro bearish market structure with any of these pullback phases. You go to retest better sell side liquidity zones before generating enough sell side volume and volatility before continuing back bearish again. Here we want to go retest roughly previous significant lows, right? You can also see with gold, it's very common that you can fake out a lot of buyers and have moves like this where it looks like gold is so bullish and going to be turning bullish on the higher time frames again. But it really just ends up being this fake out, trapping a lot of buy side liquidity and still having sellers jump into the market and dominate. We're seeing a similar sequence of events here where we pretty much had this triple top occur. And now, if we can start to see this bearish move to the downside, possible retest of this broken structure, there's a lot of potential for us to make our way slow and steady back down to the 1680s, still respecting higher time frame bears, with dollar strength being in play, Feds doing more rate hikes, and of course rate hikes leading to less demand in these asset classes like gold, real estate market, commodities, stock market, and so forth. Does that make sense to everybody? Right? Very beautiful, very easy to understand, very clean cut. The main reason for this downside has been Fed rate hike cycle. The main reason for stock market bears the last 6 months, Fed rate hike cycle. The main reason for dollar bulls, Fed rate hike cycle. The main reason for GU bears, Federal Reserve rate hike cycle, US dollar, world reserve currency, global business currency. EURUSD, same idea. Okay? Now let's bring all that information together on the table that we still want to play dollar strength, that we're jumping back into our higher time frame bias, and that we just want to adapt to what economic events we have on the docket still. Okay, so, oh, I put the wrong date in the thumbnail. I'll change the thumbnail after. It's August 15th. I thought it was August 14th still. Okay, anyways. So in terms of economic data overnight, we do have some labor market data for GBP at pre-London hours, 2 a.m. Eastern. Unemployment count change, employment change overall, and so forth. They're expecting a drop in job change here and a drop in average earnings as well. This can keep the British pound weaker against a short-term stronger yen and the dollar being stronger. I forgot to talk about it, but Japanese yen, as global economic data has been declining, has just been holding some short-term strength, hence GJ having some downside moves to start out this new week. Okay? So what we want to understand is if we have continued weak economic data overnight, for the example of the labor market data in the UK, if this data is bad, it can keep the Japanese yen a little bit more bullish on your intraday time frames because it's a safe haven currency. But also, it can take away demand from GBP because it's bad UK labor market data. So if we see negative unemployment count change, if we see a rise in the unemployment rate, a heavy drop in the employment change, average weekly earnings quarterly and monthly dropping, then that can make a weaker GBP, but also a stronger Japanese yen in the short term, leading to some more downside on GJ and also supporting more downside on GU. So keep in mind that all this data, payrolls change, average earnings, employment change, and unemployment rate, yes, it's all about the labor market, but it's still looking at different parts of the labor market. And it's all released at 2 a.m. Eastern. So you want to make sure you have one-sided data and it's not mixed, causing whipsaws and messy lower time frame price action. You either want one, all very good optimistic data that you know you can use your advantage and it might bring some short-term GBP strength, or two, what I'm expecting is the labor market starting to decline in the UK and all weaker data. What I hate is when the data is mixed. A couple reports are good, a couple reports are bad. That's what creates those double dildo candles on the hourly where you're just whipsawing up and down in the lower time frame, and nobody wants to deal with that bullshit. You want clean-cut, one-sided sentiment data, one-sided volatility that you can play to your advantage alongside price action and market structure. Okay? Okay, 5 a.m. Eastern, economic sentiment data for Euro. For Germany, but impacting Euro. Germany's economy has been dog shit. Euro's been in a recession for the last 6 months. Overall, Eurozone data is trash. If they're still expecting this data to still be in the heavy negative integers and even worsening in the negative integers, we could still use that Euro weakness to our advantage on Euro USD sells against a stronger dollar right now, with dollar index still very nice and bullish. Then through our North American trading session, we have some housing figures for Canada, won't have too much market impact. Building permits and housing numbers for the US. Housing data hasn't been having too much impact. I'm not expecting these reports to have much impact at all. What's a little bit more important is the inflation figures if you trade USDCAD or CAD JPY for Canada at 8:30. Expecting minor improvements in the inflation, but it's still more important of what the Bank of Canada is going to say towards their rate hikes after these inflation figures. The more important report we have for the US data tomorrow is the industrial production at 9:15, which is expecting a rebound. This data expecting a rebound coming out of negative integer territory and showing a rebound into 0.3%, even if it comes out at 0.2%, or if it's better than the forecast, that's going to further support dollar strength and gold bears with more optimistic US economic data, which is going to support our higher time frame bias even more. And then this is all Asian session data. You can worry about that yourself. Okay, so we understand a few things here on gold. Yes, we've been playing this pullback structure accordingly from the 1680 lows. Just like we played the pullbacks here, just like we played the pullbacks here over the last period of months. But I've started to scale in sells from the 1800s like I've given to all of you ahead of time. What we want to see now is a very similar sequence of events of either one or two situations happening, and let me describe it to you. I want either this situation where we just have the sellers in play and we break the corrective bullish structure and just start having clean cut, easy drops to the previous lows. Right? Here you peaked your sellers in play and then you have a nice shift into bearish price action. You don't have any deeper pullbacks, clean cut downside to the previous lows, right? That would be just fantastic, just starting to have the clean cut downside. But what's higher probability is scenario 2. Scenario 2 is this. you can see when we had this very aggressive bullish move here, even though we started to break this minor support zone that was being created here, and we printed a new low at that time, right? You can see you have this aggressive downside move, which is fantastic. But then you also get a 50% correction of that move, almost look like you're turning back bullish again before still continuing back bearish. Meaning you can see here a very similar sequence of events when I zoom in more, just in a smaller scale. So let's zoom in more here, and I want to show you guys what I'm talking about, right? So this double top, final sweep of those significant highs. I'll mark that in red because that 1800 zone was our significant sell side liquidity zone at these previous lows across the board here, right? So you get this very nice double rejection, which just shows us not enough buy side liquidity to break higher and collecting more sell orders. But in the range, you have this very strong support here. And here we had this very strong support at like 1786, 1785. You can see you have a beautiful, beautiful downside move that breaks that support and digs deeper, but you also have an aggressive pullback play, almost looking like you're jumping back in the range before holding below that support and continuing bearish still. Meaning, if gold was still to pull back to like 1790 and come back below that support, it would still be perfectly in line with that sequence of events and us still continuing the bearish run. Obviously, this scenario is a little bit more tricky. You have to anticipate the pullback. Shit. You have to anticipate the pullback and you have to play the pullback accordingly and start jumping back into your higher time frame sell plays, right? What we would prefer and what we would want is scenario one, where we just have the sellers in play. That upside move has been canceled out. We broke that bullish corrective pullback structure, and now we're just going to have straight clean cut sells. Downside move, minor consolidation, dump. Minor pullback, dump. Minor pullback, dump. This scenario right here would be ideal. We would all be loving that. Very clean cut sells, very nice movement, but we might not get that unless we have impulsive dollar strength and more rate hike rumors by Fed speakers later this week, right? That would be ideal. If we just have instant dump, maybe react at 1750s, that bit of a support, minor pullback or consolidation dump. This type of movement would be mwah. That would be fucking magnificent, easy money. But we can't have the perspective of looking for the most optimistic situation. We have to look for the most realistic situation. And what I'm expecting is a bit more struggle as we make our way to the downside, seeing something more similar to this. Right? Video quality is fine. Everybody's video quality is fine. It's just your internet, bro. Right? So what I'm expecting is if we don't get that clean-cut downside movement, very smooth and steady like scenario one, we're going to be playing more scenario two and still having overall downside, but these very, very aggressive pullback phases as we make our way to the downside. Okay? So now let's bring that information together for trade ideas. Potentially starting to break out of this structural point as well. Now, I can't see any more gold buys unless we were trading well above 1803 or at least 1795. Okay? Otherwise, if we get pullbacks to 1786, 1789, deeper pullbacks sells, hold that 1781 new daily candle, breaks below 1772, sells. Okay? These sets of trade ideas that I'm showing you is the main bias, main trades ideas I'm looking for with these confirms. Right? So let me type it out. Main bias sells. Dollar strength. Don't correct this downside move. If we have stronger US data tomorrow, even better. If we get Fed rate hike signals, even better. Okay? So does everybody understand? This is my main bias, the confirmations fundamentally, and what I look for technically. Now, just because this is my main bias doesn't mean we have to marry this bias, because anything can happen. What if China fires a missile to Taiwan this evening? Obviously, that's going to completely shift the sentiment and shift price action, right? That if we had that take place and Taiwan gets bombed tonight at Asian, obviously you don't want to be looking for gold sells. You want to adapt accordingly. The only way I would be looking for gold buys is breaks above 1795 and breaks above 1803 with new fear, uncertainty, and doubt. Need new FUD. Taiwan bombed. I don't know, as terrible as it sounds, but you get what I'm saying? Weak US data. Dollar bearish below 105. This is the only way I can look for buys on gold. I need some of these sequence of events. A major fundamental catalyst like Taiwan getting invaded, very, very extremely weak US data, or dollar trading below 105 and gold above these price points. Otherwise, this is what I'm mainly looking for. Okay? Now, this type of sequence of events is going to be very similar for our trade ideas on GBPUSD and EURUSD. GU for the new daily candle, even pullbacks to 1.2165, holds of 210, breaks below medium term zone at 1.2035 here, the range lows, continued sells. This is also going to be more evident if we have weak UK labor market data tonight, dollar index continuing bullish, failing to break above 1.2165, higher time frame structure still being respected. This is my main bias. The only way I can look for GU buys at this point is and adapt to a secondary bias is above 1.224. Okay? EURUSD, similar type of situation now. Pullbacks even to these range highs. Like you can see here how many times we revisited these range highs, right? Breaks below 1.014, breaks below 1.01, back to the parity point. We want to target back to the parity point. Main bias, if we have weaker euro economic data, dollar still continuing bullish overnight, euro stocks starting to give back some gains as well, I would only be taking buys on EURUSD at this point against higher time frame structure, only above 1.034. This is previous higher time frame lows, and where we had a double top here, collect a lot more sell side liquidity, continuing the higher time frame structure. Playing buys anywhere else would just be short-lived or a guessing game. USDCAD, we're starting to see as dollar strength comes back into the table, buyers back into the scene, but I would be looking for USDCAD buys only above 1.298 or retests of 283, even double bottoms at 275 at this point. Keep in mind the CAD CPI data we already discussed. No, the reason for the gold drop is the market still being fearful of more rate hikes to come from the signals we've been getting from Fed speakers over the last couple of weeks of a guaranteed possibility of a 50 basis point hike, increased probability of a 75 basis point hike, Even Jerome Powell himself said we can expect an unusually large rate hike for September still. And the market is worrisome about this because we have multiple Fed speakers this week. So they're already adjusting to potential Fed speakers bringing together more rate hike signals. Where you can see here in the middle of the week, right, on 17th and 18th, we have Michelle Bowman speaking. We have Kashkari speaking. Barkin, we have multiple Fed speakers scattered through the 17th and 18th this week, where they'll talk about monetary policy, rate hike projections, and so forth. So the market is getting fearful of them bringing more rate hike rumors to the table. Hence, dollar was holding still bulls, and gold had a hard rejection at 1800, even though we had weaker US data. The weaker US data got faded out on gold and both dollar because that sentiment of Fed rate hike rumors and fears holding more weight. Okay, so now this sucks, but all of my key levels and drawings on US 30 got deleted. So I'm just going to show you guys based on key price points of interest. Here we can see a very strong sell side liquidity zone into 34K, but we're still respecting this bear market rally and corrective structure for the time being, holding 33,250 as a support. Remember, this is a short-lived bear market rally. I could still see some short-term upside to 34,250 handle 34K before seeing sellers jump back in the market or sells below 33K flat 33,200. We've been playing this upside buys effectively with the bear market rally where we at least expected the upside to previous sell side liquidity zone at 33,500 and then also adapted accordingly above here. But we're reaching a very strong resistance zone, sell side liquidity zone at around 34K, 34,200, where I would start to look and anticipate sells in these areas and also back below 33K as we're going to get more rate hike signals by the Feds, especially if dollar strength starts to go back into the table above 107 and other global equity market regions start to turn a bit more bearish as well. Okay. Last but not least, GJ. We have to be cautious with GJ as on the higher time frame, of course, GJ is very bullish, but we've been respecting this corrective structure and we're also starting to break below very key intraday demand zones the same times we have expectations of weak UK labor market data and some short-term strength in the yen. Until the Bank of England starts to give us more signals of their rate hike plans, we have the potential where as long as we're trading below this support at 162, we can see deeper pullbacks on the higher time frame before buyers jumping back in the market. You can see that it's very, very common for GJ to have these aggressive pullback plays where it can be bearish for an extended period of time and still be respecting higher time frame bullish market structure. Right now, we are in one of these phases that we want to adapt to accordingly, especially if yen holds short-term strength. We have weaker economic data, and GJ trades and holds below 162, 161.8. On the intraday timeframes, we can also see the sequence of events as we had a lot of exhaustion and failure to break back above 162.5, where if we continue to trade below 161.5 and respect some of this intraday bearish market structure forming, even a pullback to that area can still see us have sells down to revisit this demand zone at 159.5. Right? So less demand in GBP, both against the dollar and the yen in short term. Bank of England has been quiet so far. Expectations of weaker UK economic data as GDP is still relatively low from a macro perspective. Labor market is expecting declines. Yen is still holding some short-term strength at its lows. So with that being said, pullbacks to 161.2, holds below 160.8 and breaks below 165 and 0.2, we'd be adapting to short-term sells against the higher time frame bearish trend until we revisit better buy areas of interest as shown to you on the daily and weekly time frame. Otherwise, the only way I could be jumping back into buys is if we make our way to the upside, The sells we get here are invalidated, and we're trading well back above 161.5. Okay? All right, everybody. So we went through key fundamentals in play, higher time frame structure and analysis, market sentiment, what economic events we have on the docket, technical and fundamental analysis across pairs, plus trade ideas given. This is going to be saved and uploaded so you can re-watch it as you wish. Tomorrow morning, I'll be live at 7 a.m. Eastern to do an analysis and scalping session. I'll just be giving trade ideas we'll just be giving trade ideas for scalps during the New York session, looking at price action, breaking down market structure, calling out any scalps for anybody who's watching to follow along. All right? All right, everybody. So take care. Have a great day. I'll see you tomorrow morning around 7 a.m. Eastern on this channel for a New York scalping and analysis session.